Hi guys, I hope everybody's well. Now, as you can see, I've done quite a few market breakdowns now of other pairs such as EURUSD. We've done USD CAD, gold, and I've shown you a lot of market patterns as well. And there's also the folder which shows a lot of helpful images, such as examples, like real live examples, not things off Google, but actual examples of bear flags, bull flags, head and shoulders patterns, inverse head and shoulders, fib levels, EMA, crossovers, etc. So I hope that you've so far found the course very helpful. If you've not yet covered all of it, then I'm looking forward to you moving your way through it and seeing how you get on with it. So today we're looking at not EURUSD, we're looking at EURNZD. So I want to kind of just go through this part of price action and show the amount of opportunities and how you could have basically traded those as price was progressing. So as we can see on the higher time frame, we were bearish. We had this huge runoff to the downside, and we actually took out this previous higher low and created this new lower low. Now, although this looks like there wasn't any opportunities within this trade, within this huge sell-off that we can see, actually, if we had have scaled down, there's probably lots of opportunities within this, using the strategy that I teach, such as fib levels, resting phases, moving averages, rejections, etc. So what I really want to focus on today is this part of price action. When basically price stopped, it came up, it folded, and then we continued to the downside. I'm not going to focus too much on this right now because we've actually broken out here, so we can go back to that on another date. But I just almost want to focus on this part of price action. And this isn't me almost, a lot of my videos I use bar replay, so I can show you how you can actually predict the future by anticipating future price. But I'm not actually going to do this as much in this particular video. I'm not going to do as much bar replay as such. I just really want to show you all the different opportunities so you can start seeing it yourself. So we're not going to do so much bar replay, but we're going to scale down. So what I'm going to do is I'm going to just keep flicking back and forth because obviously this price has already happened. Now, price found a bottom here around the 163.30 level. Now, on the 4 hour, when price stopped here, we had this this rollover, and we created this new higher low. Now, as you know from the videos, the first thing that we can do when we create 2 points is attach a trend line, like so, something like this. And because we don't trade point 1 and point 2, we simply anticipate point 3. Now, when we bounced off point 2, we could have simply waited for price to stop up here and drew a Fibonacci tool from here to here and anticipated the third touch before it even happened. Okay, so what we would have done is we would have put our trend line, our Fibonacci from here to here. And we would have seen that in this particular occasion, we favoured the 61.8. We favour it because it lines up perfectly with our trend line. And we can see this beautiful 4 hour rejection. Okay, it's a lovely pin bar rejection, which shows that price has respected where we thought it would respect, which was this highlighted region here. So that in itself, you could have gone long straight off that 4 hour candlestick. Long on the closure. And you could have just pretty much put your stops. Let's see how 300 fits, which is 30. So that works very well in this scenario. So we could have waited for the 4 hour to close to show that we were getting rejection. Or alternatively, we could have gone down to the 1 hour and waited for that double tap and used the first rejection as benchmarks for stops. But in this current scenario, this was a really lovely candle. It's on a higher time frame, so it shows that it's a nice strong rejection. And as I've taught you guys before with the fib rules, the first target that we go for upon bouncing off one of our retracement levels would be 0%. So in this trade example, that already in itself is a 1 to 5.75. Now the reason why we take off 50% of our trade at 0% is simply just in case we create a double top. And obviously, because we are in the grand scheme of things looking bearish on the higher time frames, that would be a realistic place to let some of your to secure some of your profit. Okay, so that would be your first target. Now, upon breaking the 0%, the next target is always the minus 27%, and then your final target would be the minus 618. So therefore, this trade would be a 1 to 12. It's a beautiful trade. It's simply waiting for the candlestick to, especially a candlestick like that. I mean, when we're looking at trades like this and we see that beautiful, it's like low tested and then closed above like this, that is a lovely candlestick to come off. So we've got 1, 2, and 3, third touch, 61.8. And that in itself is risking 30 pips for 361 pips. Beautiful, beautiful trade. And it's really just as simple as that, guys. So that would be our first trade on this particular occasion. Okay. Now, the next trade would be just using market patterns. Now, like I've said to you before, if we find inverse head and shoulders at the top of an uptrend, or we find it within a range, it's very much irrelevant. And it's very much the same with head and shoulders patterns. If we find them at the bottom or in range, as far as I'm concerned, it's not something I would trade. I only tend to trade head and shoulders at the top because for me, the head and shoulders pattern is a very strong reversal sign to say that the price is beginning to reverse. So this particular move here that we can see, where we came from the bottom here to the top, was roughly around sort of an 800, 900 pip move. Very big move. Now, when we're looking at the chart of this doesn't look so big, but it really is quite a large move. Now, we still remain very much sort of bearish on this particular time frame just because of the massive sell-off that we witnessed from the highs, which we can see when we zoom out and look on the daily. So therefore, any sort of large sort of bullish moves, we're actually treating them as retracements right now until something obvious happens. So therefore, when we see this, what would have happened is, let me do a quick bar replay on this, is we came up like this, we formed this sort of where we retraced slightly, we came up to create a higher high, and then we sort of capped off here, okay? So the moment we form this, we know already that we can put a resistance on what we believe to be potentially a left shoulder. But we're not so sure yet. We don't know yet. And this is how we have to use this to anticipate future price. Now, when we get this and then we get what we think is the head, and then we get this second touch, 1 touch, 2 touch, obviously the first thing we can do is apply what we think might be a neckline. Okay, so therefore we'd apply a neckline like this. Okay, so now we've got a left shoulder, we're anticipating a right shoulder. Now, at the moment, we don't know what this is. We don't know whether it's going to be a head and shoulders pattern. For all we know, price could just pop up here and create another new higher high. So therefore, we have to use what we have available to us to predict future price. So like I said, the first time you get this, and then it comes down again like this, you've got point 1 and 2. The first thing that you do when you have point 1 and 2 is you apply a neckline, and then you simply cap off what you believe to be the left shoulder resistance. Okay, so therefore we would duplicate the left shoulder because we're looking for equal movements. We place this here. And another thing we can do as confirmation, which works really well with the head and shoulders pattern, is generally the right shoulder will line up with a nice fib level. Something like that. So generally they line up between the 50 and the 61.8. So we already know that this is our highlighted region. This is our area of interest where if price basically begins to come up and reject, we already know that we'll be looking for shorts because we're anticipating a head and shoulders pattern. Because it's at the top of an up move. We've created what we believe is the left shoulder, the head. We've created these 2 touches, which has allowed us to apply what we believe is a neckline. It's actually rejected this, so now we're anticipating price to come up, create an equal move to create the right shoulder, come down. We're basically looking to place a short from here, come down, crash through the neckline, And then obviously targets for head and shoulders pattern would be duplication from neck to head. So let's just see how this plays out. Okay, so we actually came up and double tapped it, it proves my theory even more really about almost waiting for the first tap and coming on the second. Now, whether you would have done this or not, it doesn't really matter because both ways would have worked in this scenario. We came up and we created this doji and what looks like a sort of like a small spinning top really, which shows indecision and a slowdown in momentum, which proves to us really on the 4 hour time frame that price is respecting where we thought it would respect, this highlighted region. Now, what we would have to do on this is because we have highlighted this area, we wouldn't actually be trading this off the 4 hour. This is a 4 hour pattern, but we'd actually be scaling down once we find once price starts approaching us, our highlighted region, we would then be scaling down. Okay, so this is our pattern. It looks a little bit messy on an hourly, but we'd have to be on an hour on this because we'd need to see the taps and the rejections. So let's just play price so we can figure out on this particular example where we would place an entry. Okay, so we're beginning to approach our area of interest. Beautiful. Now, to be quite honest with you, there's absolutely nothing wrong whatsoever with getting in here. Absolutely nothing wrong. And we can quite clearly see where we would get in here. This candlestick here is an engulfing candle, it engulfs the previous candle. We've come up to tap and we've respected the exact area we're looking to place an entry. So there's absolutely nothing wrong whatsoever with going short here. Now let's see what the stops would look like at 30 pips. Yeah, that's quite a nice stop. Now let's see how price would react to this. So therefore our first target would be the neckline, which gives us a nice 1 to 4. But our longer term target on this particular trade would obviously be duplication from the head to the neck. So this is where we would have taken 50% off, which is at the neckline, just in case we bounce. In fact, that is actually what we did. But the actual longer term target for this would be from the neckline to the head. And this is where we would be duplicating because we know that market patterns trump market structure. So a lot of people with using this setup, if they were doing a fib level from here, they would be targeting the 0%, which is obviously where the neckline pretty much is here, and then they would be targeting the minus 27 and the minus 618. But we know that market patterns trump market structure and they also trump Fibonacci extensions. So therefore, it's in our best interest actually try and hold this trade down to here, which would give us a 1 to 14. So it's a very worthy trade. It's a very good trade to hold. So that would have been our trade. So let's just see how this plays out, because this stop was a very tight stop. What I'm actually going to do is, because this is still in play, I'm going to remain that we're on the 1 hour time frame. Okay, so as I was saying, on the, we would have taken 50% of our trade off at the neckline, and we would have basically allowed the rest of the trade to run to duplication of the head and shoulders pattern. Now, price came down to, once again, test the neckline, and we had a strong reaction from this, and we came out to form this, almost this second tap, really, of the area. Now, this was extremely close. We would have probably got stopped out on this, maybe, depending on the spreads. But if we had have been stopped out on this first entry, the actual second entry could have even been a better entry. So therefore, we probably would have taken 50% of our trade off here, come back up, from this second touch of the left shoulder resistance, actually tapped the 618, which was beautiful, beautiful conferences, and again formed this bearish engulfing candlestick. So this would have been our second entry if we had have got stopped on this. And again, we would have just simply put our stops 30 pips above. It's almost its first tap. So we've actually got a great benchmark here for our stops. So that would have been a really fantastic trade to come straight off this bearish engulfing. And again, we would be targeting and taking a percentage of our trade off at the neckline, which would be around this kind of region here, where the 0% is, sort of like a 1 to 5, something like that. But, you know, our longer term targets would be duplication. It would be duplication, okay, of the actual market pattern. Because, like I said, we know that market patterns trump market structure. So therefore, our long-term target would be here, which would provide us with a 1 to 15. Okay, so what I'm going to do is I'm actually going to leave this risk to reward in place just to see if we actually hit our target, just out of curiosity. So that would have been our first trade. Now, if we were to look into getting into this head and shoulders pattern and we had missed this sort of first entry here and this second entry, where would be our next entry on this particular pair? So basically what we would do is we would wait for the neckline to be broken, and we wouldn't be you know, getting fear of missing out. We would simply just wait for the retest, confirm it is a retest, and then that would be our next position. Now, we can either scale in and place a second position on this. So this would be our first position. Or if we'd missed this, this would have been our first position. So this is our first position. If we had a retest of this neckline, that would be our second. But if we missed that, this would then be our next opportunity to get into this particular trade. So I'm going to play this out and see what happened next. Head and shoulders patterns are very powerful patterns. Now, as I said, at this point, we've proved that we've stopped because of this large bullish engulfing candlestick. So the first thing that we can do when price stops is we apply our fib tool. Now, we can start to see already that our favourite area of interest is here. Why? Because we've got the 61.8 and we've got the retest of the neckline. So therefore, yet again, we would be scaling in once we begin to approach this level to look for entries. Okay, so that's exactly what I'm going to do now. Is I'm going to scale in on the 1 hour and look for some entries. Okay, so here we have price. We've drawn our fib because price is now stopped. And we are looking for price now to come up and retest the neckline for either another second sell and a scale in, or our next entry if we'd missed the previous entries. So now let's watch price, and we have to be on the smaller time frames when price starts approaching favoured areas of interest so we can get a better position. So let's just watch this and see how it plays out. Okay, so we're starting to reject it. That was our first almost rejection. Rejected it again. And now we're beginning to almost sort of collapse and come down. Are we going to take a next pass at this? Maybe not. Okay. Let's keep watching price. And then we can go back and figure out where we would have got in on this. Now, this is our second pass. Can you see this? Can you see how I now wait for my second pass? It's truly amazing how market allows you multiple opportunities to get into a trade. It's almost like it's running back to get you. So we have multiple entries here that we could have got in on. And I'm just going to actually just pause this for a minute. Now, if we were going on my theory of the second tap, we could have simply just got in here. Okay, what we could have basically done is we could have got in, once we realised that this was our second tap, we formed this bearish candle, which almost looks like a bit of a spinning top. And we could have gone short with a second rejection and just ensuring that we clear this one here. So therefore, again, we just have to make sure that our stop's kind of like 30, 35 pips above, something like that. Ensuring that it's clearing this level here. And obviously, most importantly, it's above the neckline, okay? So this would be a really, really great trade. Now, if you hadn't have waited for the second touch, that's understandable because after the first touch, we had this huge sort of, 6930 to, that's quite a large drop before we came and retraced. If you hadn't have got in there, you could have simply got in on one of these rejections, waited for this first tap, second tap, and you would have had to basically get in on this candlestick here and allowed yourself enough room above here. So this would have probably been a little bit of a larger stop. I would have probably given this maybe 45 pips, something like that. Maybe 50 pips, 45, 50 pips. To clear yourself. Now again, we have to remember that on the retest of the neckline, the actual duplication from neckline to head is still very much in play. That is still the long-term target. So if we had have missed this trade, the next one would also be here as well. Okay? This would have been our next trade, a retest of the neckline and the 61.8. So we would have either got in here or we would have got in here. And we can actually see on the 4 hour that we in fact had 3 taps. 1, 2, and 3. 3 taps, 3 opportunities to get in on this particular market. So if you'd missed this one, you could have gotten in this one. If you missed this one, you could have simply got in here. So there's 3 opportunities there to get in. So that in itself, as long as it obviously hits target, would have been another 1 to 6. So therefore, we would have taken off 50% of our profit here at 1 to 4, and would have let the rest of the trade run to the main target here, which is on this particular scenario, it actually lines up very well with the minus 27%. Okay, so that would have been our next trade. Great. I'm going to remove this tool now. Just neaten things up a little bit. So just to recap, we had this large up move. 1, 2, 3. We took a trigger off here of the 4 hour pin bar, which was also the 61.8 and the touch of an ascending trend line. We had a massive risk to reward here, where we targeted the 0%, then we targeted the minus 27, and then the minus 618. And then we started to see a left shoulder ahead. Once we saw this point here, and we had 1 touch, 2 touch, we capped off the neckline, capped off the left shoulder resistance, anticipated the right shoulder, had 2 opportunities to get in here. And then we waited for a break, a retest, had 1, 2, and 3 taps of the retest to provide us with 3 opportunities to go short furthermore. And now we're looking for more opportunities within this market. More opportunities. So I'm just going to literally freehand all of this because, like I said, none of this is actually really rehearsed. So if we were to go from here to here because price stopped, did we hit anything there? Yeah, we did. We hit the 38.2. Now, generally with high momentum trades like this, we normally only come as far as the 38.2. We knew we weren't going to come above the 78.6 or the 61.8 because the 4 hour 50 EMA was providing us with some dynamic resistance. And again, this is another beautiful trade. When price stops, attach a fib. Now let's just scale down on this particular trade because this could have been a really, really fantastic trade. So price stopped, we came up. Wow, look at that. Not only did we hit the 1 hour 50 EMA, we hit the 38.2, multiple confidences here. Amazing trade. Amazing trade. I mean, you really could have just come straight off this bearish engulfing candlestick. And again, put your stops 30 pips above. Probably in this case, it would have been better to clear those wicks. So maybe 35 pips would have been better. As long as you're above the 1 hour 50 EMA. And your target would have been the 0% first, which would have given you a 1 to 2.3. If we can clear the 0%, the next target would be the minus 27. And longer term targets would be minus 618. Okay, those fib levels work very well. Let's scale back out. So we can actually see that the target was hit very well. So that was another 1 to 6.58. Let's see if we can see any more of these. Is this one here? This may be another one. This looks like another little one. Because the first thing that we do is we attach a fib when price stops. So let's scale down a minute and let's see if this was another one. Like I said, guys, this isn't rehearsed. I'm literally just running straight through the chart and trying to show you that the moment price stops, the first thing you should do is apply a fib. Okay, so this would have been our next trade, but then if we go from here to here, from this move to this move, we came up again, look, touched the 50% and the 50 EMA, hit target 1, hit target 2 to perfection. So ignore this trade just for a second. We're now focused on this part, where basically we would have gone short of this high test candle here, which closed just below the 38.2. So you could have even gone here really, and again put your stops 30 pips above. Let's see how that looks. Yeah, the EURNZD moves quite rapidly, so you have to allow a little bit more space. But again, 0%, minus 27, long-term target. Maybe not as good as a trade because it's quite a messy scaling, but nevertheless, it's still a trade. I'm just trying to teach you guys how to pretty much apply the fib every single time price stops. That could have been probably potentially a day trade. Now let's scale back out and see if we can see any more opportunities. Now I can begin to see what looks like to me 1.2.3. So let's now see that if we had have seen these 2 points here, would have we have drawn a trend line on it. So let's go from here to here. That looks very good to me. So what I'm going to do is I'm actually going to remove these just for a second to clean things up a little bit. So you could have drawn a larger fib from here to here. That's a brilliant trade. Brilliant trade. We've got the 4 hour 50 EMA that's moving through price and it's capping it beautifully. We've got this 38.2 rejection, which we can see multiple 4 hour candles. That in itself could have been a great opportunity to go short. Wow, I mean, you could have come off any of these candles, really. Beautiful tap. One tap here. So one tap, two tap. So what I probably would have got in on is I would have waited for this first tap and got in on this second tap. Where I would have probably got in on, likely probably this candlestick here. And as long as I'm above this previous wick here, so I would have probably done something like a 40 pip stop on this particular trade. And again, because it's a fib level, I would now scale back out, and my short-term target would be the 0%. And if I break the 0% after taking off some profit at the 0%, my next target would be the minus 27%. Now, let's have a look at this. Let's see what happens next. So we broke out and we came up and tested this point here. Now, if we look at this from a bigger perspective, I think once we created this point here, we probably could have done a longer fib on this and seen if this lines up. Beautiful. You can quite clearly see that lines up beautifully. So therefore, because basically price had stopped, we could have applied our fib. We've got the 78.6, which has been respected beautifully. That in itself could have been a trade, but really that probably wouldn't have been a trade as such for us because we don't tend to trade the second touch. But what this would have done for us is it would have confirmed to us a nice trend line that we could have now applied because we've got one touch and two touch, so therefore we can now apply a trend line. We've created this new lower low in comparison to this lower low here. So now we're anticipating a new lower low. So therefore, when we came up to touch the 78.6, we could have applied our trend line and now we're anticipating a new lower low, which is down here, okay? Now, when this was formed, price actually stopped. Like so. What we could have done is basically, let me just show you this on a bar replay. So we're creating these lower lows. I'm going to make this a little bit bigger. Lower low. Lower low. Lower high. Lower high. So we've got 1 and 2. We don't generally trade the 1 and 2. Because we need it to confirm that this is what we think that this is. Now, once price actually finally made it stop, we can simply go from here to here. Now, we can quite clearly see that on this particular occasion, the 78.6 lines up very well with this trend line. So therefore, if we're looking at these other fibs, probably on this occasion, we're probably looking at price coming as far as the 6-7 sort of 50 area. Now, how would we have known that we could confirm this? Now, when I see this and then I see this, and then price comes back up to test the 4-hour 50, pause and come back again, what is the first thing that I can do? This is a large down move, so therefore I am thinking to myself, this could be an inverse head and shoulders. Okay, so what I would do is I'd cap off what I think is the neckline. I'd cap off the left shoulder support. I would duplicate the left shoulder, like so. Anticipate the price was going to come down to here. I would fib price from here to see if I got my 61.8, which I did, which is another strong confirmation that this is what I think it is. And therefore, my target would be duplication from head to neck, which, as you can see, perfectly lines up with what we think price is going to do next. So this is how we could have known that there was another layer of confidence that price was very much likely going to come to the 78.6. Now, generally what happens with inverse head and shoulders, and I found this to be true a lot of the time, is that when you have a 1 hour head and shoulders, is what happens is that when you get this move here, this left shoulder and the head, when this price begins coming up to create this second point to allow you to draw a neckline, normally it rejects the EMA, comes down, forms the right shoulder, and then pops through the EMA. So normally you'll find that this point here comes up and actually touches the 50 EMA at the same time. I want to show you guys another example of this, but it works beautifully in the sense that price pops up, tests the EMA, comes down, forms the right shoulder, and pops up to the duplication. Now, obviously, invalidation for this particular pattern would be below the 78.6. So therefore, as long as price did not break below here, then this looks pretty good to go. So let's see what happened next with price. So it was a nice rejection. and then we came up and hit exact duplication. Wow, perfect. And then we retraced. So therefore, almost, we knew that anyway we were going to come up to here, but we used this inverse head and shoulders to actually confirm it even more so for us. Okay, so what I'm going to do now is I'm actually going to scale down the 1 hour again, because like I said, we would have highlighted this right shoulder as an area of interest once the left shoulder and the head had created and we had the neckline. So what I wanted to do now is show you how we could have waited on this. So what we could have basically done is once we'd seen this rejection here, this cluster, we could have simply gone long. We've had 1, 2, 3, 4 rejections. Let's see how. Yep, that's a nice, as long as we're below the left shoulder, gives us a nice breathing space. And let's scale back out. And therefore our target would be duplication. So that in itself would be a 1 to 7.5. So that's a beautiful example of an inverse head and shoulders. Like I said, we'd have to wait for this rejection. Generally, the neckline rejection also pops off the 50 EMA. So just remember that. Normally on like a 1 hour pattern, it's the 1 hour 50. And you know, on the 4 hour, it's the 4 hour 50. So that works really, really well together. It's another layer of confluence. Generally, you'll come up, hit this, drop down, create your right shoulder, as long as it doesn't break below the left shoulder support. And then you'd scale down because this was already an area of interest. So therefore, if this was a 4 hour pattern, you'd scale to the 1 hour. If it's a 1 hour pattern, you scale down to the 15 minutes, confirm that it is indeed rejecting where you think it's going to reject. And then therefore you would execute longs and you'd be getting out at duplication. Unless there was something really, really obvious, like a very strong weekly support or resistance, then obviously things can get a little bit different. But in this case, it hit target perfectly. And in addition to that, once it hit the 78.6, we could have also shorted it because this is our new lower high. So again, we would scale down once we start approaching the 78.6. Which is here. Sorry guys, bear with me. And we can quite clearly see we had this very high test shoot. And then we had this this bearish engulfing candlestick. So we could have basically gone short and ensured that our position was here, which is a much better entry. And let's see what this looks like. So we could have done a 45 pip maybe, something like that. As long as we're above the previous wick. And again, in this particular scenario, we would be targeting the 0%, which was down here. Okay, now, obviously, as you can see, we didn't actually reach this target. We didn't hit this target, unfortunately, because we actually came down. So let's just recap. This was a 1 to 7 just off duplication of the inverse head and shoulders, found at the bottom of a large down move. And then we actually sold anyway because we created this new lower high, which we anticipated because we fibbed from here to the point where price stopped. We came up, the 78.6 lined up with the downward, the descending trend line. And we also confirmed that the 78.6 was the price we were going to go to as well, because we had this inverse head and shoulders and the duplication lined up also with this too. So that was a really beautiful trade. Now, as you can see, like I teach you guys, when you come off any of these fib levels, the first target we go for is 0% to take off 50%. Now, in this current scenario, unfortunately, we did not hit the full target that we were anticipating. What actually happened was we came down and we created this new 4-hour high above previous lows. Okay, so that was a bit of a concern. Now the thing that we can do, obviously when we create 2 points, is the first thing that we do is we attach a trend line, okay, like this. So drag this out. Obviously I appreciate price wouldn't have been here at this point, but we can still drag this trend line out. So therefore we would have attached a thing like this. So we didn't hit target, we bounced. So therefore once we started seeing these sort of hammers, that would have been our sign to actually get out of this trade. So either way, it would have been a great trade. Now, once we start coming into this triangular formation, like so, and we start coming up again to meet these previous highs, we could have still fibbed it from here to here because price had stopped. And in this case, this would have been invalidated. We closed above. So therefore, we wouldn't have actually placed a trade on this. Okay, but we now are in this triangular formation where we are pretty much sitting on our hands and waiting for price to either break to the upside or actually break this line. So generally speaking, when we came down and we actually broke this, the first thing that we do when we break a trend line is we look for a retest. Okay, so when price broke the trend line and finally made its decision to stop, which it showed us here, when it formed this 4-hour sort of hammer, or you can call it almost like a pin bar, it's a bullish candlestick, we could have simply applied our fib and waited for the tap of the 61.8. Okay, so again, we have multiple tap, tap, tap. We would have known that this was our area of interest here. So therefore, this is where we'd be looking to place shorts of the 61.8. We know on this example that the 78.6 is above. So therefore, that's very unlikely that price is going to come this far. And it's probably not going to come to the 30.2 or the 50 because it doesn't really line up very well with the trend line we're trying to retest. So therefore, it's in our best interest to try and target the 61.8. So therefore, we would scale down and we'd wait. So the first entry that I think most people would have taken would have been the obvious one, which is here. So we've come up and just come shy of the 61.8, probably by about 5 pips. Most people would have got in on this hourly bearish engulfing candlestick. And allowing yourself enough pips, I would have probably put 45 pips in this particular trade because it's just above. Let it breathe a little bit. Scale back out. And again, we'd be targeting the 0% first to take off 50% of our trade. And then we'd be targeting the minus 27 as the longer term. Now, on this particular trade, what would have happened is we would have been stopped out if we hadn't have left it enough space to breathe. So if that was my trade, I probably would have been stopped out at break even. So risk to reward of 5 to 5. I don't really like to do stop losses any more than 45 pips. So therefore, I'd be looking for more opportunities to get in on this particular trade. So again, we come back up to my favorite area of interest. And we created this other slowdown in momentum, doji, followed by bearish engulfing, came back up. To be honest with you, you could have pretty much got in on this bearish engulfing, this doji and this bearish engulfing candlestick. Gone short here. Giving yourself enough space to breathe, 30 to 40 pips. As you can see, we actually came up to pop this again. And again, the same targets would apply. We'd be going for the 0%, which is down here. And then overall targets, if we broke this, we'd be going for the minus 27%. That would have been our next trade on this. It would have been a break and a retest of this. So that's pretty much a 1 to 7. Lovely. Beautiful, beautiful, beautiful. So what I want to do is I want to just scale out quickly and show you the multiple trades that we could have taken on this. Now, we had this trade here that we could have taken, obviously on the third touch of this ascending trend line. 1, 2, 3. We fibbed it from here to here. We had the rejection of the third point, the 618. So that was our first trade, which I believe was a very high risk to reward ratio. The second trade that we had was the head and shoulders formation, which, by the way, we did hit target. We hit both of these targets. These are swing trades, especially when you're going for something like a 1 to 15, which is an insane amount of risk to reward, just off a market pattern. We found the head and shoulders pattern at the top of a large move to the upside. Once the left shoulder, and then we came down to form this rejection here, it allowed us to draw this neckline and anticipate the right shoulder from equal movements of the left, and it was also a fib retracement from here to here. So that would have been our second trade. Our third trade would have been a retest of the neckline. There's a couple of sort of day trades on the way down here. And then when we came up to form this point here, this would have been our second touch, which formed at the 78.6. We wouldn't have probably traded that because it's only the second touch, but this would have allowed us to form a trend line. So therefore we'd be anticipating the third touch, which lined up beautifully with the 78.6. As an extra layer of confirmation, we also saw an inverse head and shoulders here, which you can't see on the daily right now, but on the smaller time frame, the 4 hour, we saw this inverse head and shoulders, which we duplicated, which also confirmed our targets of 78.6. So that would have been a really fantastic trade to both take here of the rejection of the right shoulder and of the third touch of the descending trend after 78.6. So that was also a trade here and a trade here. And then we wouldn't have traded this. And then we would have waited for the retest. We got stopped down the first one, probably at break even, or even a 40 pip loss. And then this would have been our final trade upon a retest and the 61.8 retracement, to which we took 50% off at 0%, and we held the rest of the trade to minus 27%. So there's multiple trades within this. And in fact, if you scale down to the 1 hour, there's probably even more retracements. Lots more day trades. So this was from a span of the beginning of December until really sort of towards the end of March. So, we could go through and add this up together, the amount of pips that we've made on this. But I predict, that's 450. This trade here was massive. I think it was sort of from here to here. Yeah, that in itself was a 1 to 12. That was 360 pips. So 360 there. You've got 450 there. So that's already 800 pips. And then you've got another 300. That's 1100. You had this point here that you could have gone short with, which didn't exactly hit the exact target we were hoping for. We had another point here. So there's probably about, I'd probably say about 1500, maybe 2000 pips within a sort of 3-month period. Not a bad trade at all. So you can see how we can achieve tight stop losses by simply scaling in to areas of interest, waiting for the first tap, getting in on the second tap, or seeing things like bearish or bullish engulfing sticks around areas of interest on the smaller time frames, and using the previous candle as our benchmarks for stops. So if you guys have any more questions on this particular video, feel free to hit me up. Obviously, I appreciate it's been a little bit messy because it's not been rehearsed. I've been almost moving through it as if I wasn't looking at this before. And I hope you guys have found this one interesting.